It's good for you to. Okay. All right. So we are going to be discussing project specific tonight, and it's a very frequently tested area of cost of capital in recent time. You know, if it doesn't come as a standalone question, usually, in fact, for the past, let me say, for the past 6 to 10 diets, it has been possibly as a sub requirement. Okay, the last time ICAN tested complete question, apart from the one we solved last time on Gene Daddy, right? A complete question as compulsory was 2018 on cost of capital. You know, ever since then, it has been a kind of a sub requirement, often under capital budgeting as well as a business valuation. But the bottom line is that project-specific cost of capital is very straightforward and easy to understand if you understand, I mean, if you know the concept, I mean, the procedures. However, of course, this is financial management. So when, like I mentioned to you last week, in November 2025, when financial management was introduced, project-specific cost of capital was tested, right? So, but you don't know what is coming, and that's why you just have to ensure that you cover your syllabus as, I mean, as expected. All right, so now, when we started this topic, cost of capital, I mentioned that there are three categories of cost of capital. We have discussed traditional weighted average cost of capital. We're about to discuss project-specific cost of capital, and the third one is weighted average cost of capital of the combined activity. I told you that traditional work is computed, all right? Traditional work is computed. Who is that person? You guys have started again. Shola, Jamila, Imem, please mute. So I told you that traditional weighted average cost of capital is estimated when information about capital structure, that is ordinary share capital, preference share capital, as well as debt capital are given in a question. Okay, including interest and dividend. That is when you calculate, that is when you use traditional model to calculate weighted average cost of capital. So under project specific, what are you supposed to look out for in a question? All right, so let's start from there. This is estimated. This is estimated. Or let me put it this way. When a company is diversifying, okay. When a company is diversifying or when systematic, business and financial risk of a company is expected to change. When systematic business and financial risk of a company is expected to change. Yes, Shola, talk to me.
Good evening, sir.
Yeah,
Hello, sir.
good evening.
So, so I don't want to look like a disobedient child. So you discover that you normally see me and I do not like mute. What happens is that I use my desktop. So I don't know what happened to my desktop. I won't be able to hear. I mean, you won't be able to hear me if I talk to you. You won't be able to hear me, but I can hear you. You understand now? So, and I cannot
Okay.
also mute from my end here. So I have to like maybe use my phone to connect sometimes. Anytime I speak to you, just know that I'm speaking through my phone. So it's not as if I do that
It's okay.
deliberately. Please, it's
It's
either you
okay.
just
It's
maybe
this.
mute for me.
Yeah,
So that's what happened.
that is noted. That is noted. All right.
All right, sir. Thank you, sir.
Okay. All right. So, like I was trying to say, our project-specific cost of capital is computed when a company is diversifying or when systematic business and financial risk of a company is expected to change as a result of undertaking a project. As a result of undertaking a project. All right. So when a company moves, all right, when a company moves to a new industry, when a company moves to a new industry, to a new industry, the existing work, the existing work of the company will not be suitable to evaluate projects in the new industry. In the new industry. Therefore, a cost of capital that will be an appropriate, let me put it this way. Therefore, an appropriate cost of capital, that will be consistent with a systematic, or that will be, let me put it this way, that will be consistent with a project risk. Will need to be estimated. All right. This is what is known as project-specific cost of capital. All right. So what am I trying to say here? The key points or the key ingredients to know, to look out for in a question, whether you are going to calculate project-specific, is the fact that if the company is diversifying, all right? So if you are told in a question that a company is diversifying into a new industry, and you are required to calculate appropriate cost of capital. So you need nobody to tell you that you are going to estimate project-specific cost of capital. That is the thing you need to, that's the key point you need to look out for as far as project-specific is concerned. Let's say, for example, Equity Professionals Limited is into education business. If Equity is contemplating in diversifying into real estate, and there is need to undertake a project in real estate, So the current work of equity professional in education business cannot be used to appraise projects in the real estate. Therefore, a cost of capital that will be suitable to evaluate projects in the real estate will need to be estimated. So this is what we call project-specific cost of capital. So in a question, once you can see anything that relates to diversity or any indication of diversification, you should know that you are going to estimate project-specific cost of capital. If examiner is in love with you, they can mention in the question that the company is diversifying. But once you can see any indication, let's say, for example, you are told that the company is into oil and gas. The company is now contemplating in evaluating project. I mean, it's contemplating in taking investment opportunity in communication business. So you are moving from oil and gas to communication. So that means the company is diversifying, because it is not at all time the examiner will mention diversification in the question or diversifying. Once there's an indication that the company is moving from one industry to another industry, then project-specific cost of capital is calling on you. That's what you need to look out for. All right. Like the question that was tested last in November died. So the company was moving from one industry to another industry. So it was very clear, very simple, straightforward question for that matter. By the time we are done today, of course, you go all out, you'll be ready to solve that particular question. Well, in any case, let's move on. So what are the procedures? Before we begin to talk about the procedures, let's talk about some terminologies. All right. So you need to know about one, what is business risk? Okay. Let me just, because of time. What do you mean by business risk? Business risk is the risk that is associated with the industry where a company operates. And it is also known as operating risk. That is the risk that involves in the variability of cash flows, including revenue or sales, operating profits, right? Operating costs, initial outlay, any changes in your cash flow. Okay, a company, usually every company has budget, right? So you would have anticipated that this is how much sales we are going to make in this particular year. So market condition or operating environment can limit the ability of the company to achieve its targeted revenue. That's a risk, because you would have built your budget on the basis, I mean, from the top to the bottom, that, okay, you are going to have achieved 25% revenue target for the year, right? But because of prevailing market condition, the company may not be able to achieve that. That's a risk, all right? So, and this is what this business risk is the risk associated with the industry where a company operates. So because you want to, okay, before then, when I get to, I will explain, but in that case, let me just, because of time, let me limit my talking. Now, I say business risk, let me put it down for you. This is the risk associated with the industry where a company operates. All right. It is also known as operating risk. That is the risk involves in the variability of cash flows, including sales, or you call it revenue, sales, operating costs, operating profits, initial outlay. Okay. All right. Let me put etc. All right. So this is what is known as business risk. It is measured. Business risk is measured by, asset beta. Okay. That's that. Next one. Let me do it this way. The next one is financial risk. What do you mean by financial risk? Financial risk is the risk arising from debt financing. So when a company finances its operation with elements of debt, including bonds, debentures, loan notes, or bank loan, then the company may be exposed to financial risk. All right. The financial risk is measured by equity beta, and it is always higher than the asset beta. When we get there, I will mention that. Okay, so I said financial risk. This represents the risk arising from debt financing. Okay, from debt financing. So this represents the risk arising from debt financing. When a company finances its operation with debts, including bonds, debenture, loan notes, or bank loan, the company may be exposed to financial risk. The financial risk is measured by equity beta. Okay, so that's that as per financial risk. Next, proxy company. Proxy company. What do you understand by proxy company? Proxy company is a comparable company that operates in the industry where a company is moving to. It is usually assumed that both the main company and the proxy company all have the same business risk, okay? Have similar business risk. All right. This is also known as a comparable company. It represents the company. It represents the company or the companies. It represents the company, let me put it this way, or companies that is or are already operating in the industry where the main company is moving to. It is assumed that both the main company and proxy company have similar business risk. So that's why the company is borrowing the beta of the proxy. So what we are saying here is that when a company is diversifying into a new industry, all right, of course, the company will be new in that particular industry. So you need to get the beta of the existing company already operating in the new industry you are moving to. So it is that beta of the company that are already operating there that you are going to use to determine the business risk associated with that particular industry. So let's say, for example, like I mentioned earlier, equity professional is into education business and the company is diversifying into real estate. So once equity professional want to execute projects in the real estate, you need to meet the operator, the existing operators in the real estate. All right, those companies already operating there are what is known proxy company. All right, if there are more than one, it will be proxy companies. Okay, so that is as per that. Next, beta. What do you mean by beta? This measures, or this is, let me put it this way, this is used to measure systematic business and financial risk. Okay, systematic business and financial risk. Basically, beta can be divided, or let me put it this way. Basically, there are two types. Basically, there are two types of beta, including number one, asset beta. Examiner can ask you to explain some of these things. That's what I'm giving it to you. Asset beta. Like I mentioned earlier, asset beta measures only business risk. You use asset beta to measure business risk. Okay. And then, of course, it is also known as on-gear beta. Let me just put it down. This is used to measure only business risk. Okay, business risk is used to measure the risk associated with the industry where a company operates. So to measure that business risk, you are supposed to calculate asset beta. So it is asset beta that you are going to use to measure the business risk. So this is used to measure only business risk, and it is also known as on-gear beta. Okay, on-gear beta. All right. No story. The second one is equity beta. Equity beta. This measures both business and financial risk. This measures both business and financial risk. And it is always higher than the asset beta. It's always higher than the asset beta. Okay. So where a company is wholly financed, with equity, that is 100% equity, no debts, asset beta, let me put this, assets and equity beta will be the same. All right. So asset beta and equity beta is the same, where a company finances its operation 100% of equity. All right. So these are some of the terminologies you need to get familiar with under this project specific. All right. So the next we want to discuss are the steps. What are the steps involved in calculating project specific cost of capital? Let me go up there so that somebody can be asking me, what do you mean by PS, project specific cost of capital? All right. So step one, anytime you want to calculate project specific cost of capital, there are 5 steps you are supposed to carry out. The first step is to identify the proxy beta. Step 2, you ungear the beta if it is geared. Then step 3, you regear to incorporate the financial risk of the main company. Then step 4, you calculate cost of equity using capital as a pricing model. Then finally, step 5, you calculate project specific WACC. It's as simple as that. So to simplify things for you, so anytime you are calculating project specific, just know that there are 5 steps, and I'll put it in acronyms. The first step is project proxy company. The second one is to ungear. The third step is to regear. The fourth, step number 4, is to calculate capital as a pricing model. Then step number 5 is to calculate WACC. These are the acronyms that you can use to calculate project specific WACC. So the first one says we should identify proxy beta. All right. So how do you identify proxy beta? You go to the question. When you are given a scenario, the first paragraph, certainly examiner is going to mention the name of the main company. The name of the main company will be mentioned. Any other name that you see thereafter will then represent the proxy company. Okay, that will represent the proxy company. You then check the financial statistics of the proxy company. Any information, you are going to see beta value there. So just pick the beta. So that means you have identified the beta. Then step 2 says you should ungear the beta. That is you ungear the beta. All right, if geared. Ungear the beta. Let me put it this way. Ungear the beta in step 1 if geared. So if the beta is geared, you need to ungear it. What do you mean by if geared? Okay, the beta will be geared. Let me put further information there. The beta will be geared if the proxy company has debts in its capital structure. The beta will be geared if the proxy company has debts in its capital structure. So when you can see any element of debts in the company's capital structure, it means that capital, then structure. So it means that the beta in step 1 is geared. So I said the beta will be geared if the proxy company has debts. Okay, including, let me put it further, including bond, debenture, loan notes. Amarachi, stop it. Bond, debenture, loan notes, or bank loan. When you see any element of debt in the capital structure of the proxy company, it means that the beta you have identified in step 1 is geared. So if it is geared, then you need to ungear it. All right. So how do you then ungear? All right. The formula below. The formula below can be used. Can be used to ungear depending on whether or not that beta is given. Okay, depending on whether or not that beta is given. Because of, let me see, if I can even call, I don't need to be, this will waste our time. So I can't be writing everything. Let me just check. Hold on for me. Let me see if I have your material available. Okay, let me just, because of time, we have to finish this topic today. I have to finish this. Let me open to your material. It's already there. So, because I'm thinking, I'm thinking out loud because the way that I'm going, I like to talk. So I don't want to. Okay, let me just. Okay, let me use. No, it will be different from what I have because I need to share the complete material on this. Otherwise, okay, let me just copy this. Let me just copy this for the purpose of my explanation. Okay. Let me increase the font. No. So let me copy this so that it will be faster for me. That's it. So let's continue. I don't need this. So, like I was trying to say, anytime you want to calculate asset beta, that is, you want to ungear the beta you have in step 1, right? So there are 2 different formulas that you can use depending on the information, depending on your choice. All right, you are still going to get the same answer. So if in a question, the first one is, let me start with where, okay, let me see. Okay, let me do it this way. Okay, this is it. This is it here. Let me just copy this. Now, the first instance is that where debt beta is not given, okay? Where debt beta is not given. So if you are not given debt beta, how do you calculate your asset beta? Okay? Because according to Miller and Modigliani, those 2 controversial guys said that debt beta is always a risk-free. So if debt beta is risk-free, right? In that case, how are you supposed to calculate your asset beta? That is risk-free. Risk-free. So how are you supposed to calculate your asset beta? So your asset beta is denoted as BA, is computed as beta equity of a gear company multiplied by equity value of a proxy over equity value plus debt value of a proxy company multiplied by 1 minus tax rates of the proxy company. That is the formula to calculate asset beta, where debt beta is assumed to be risk-free. Okay, I will explain the variables later on. All right, so alternatively, if I don't want to use the first formula, I can use this other formula, the one you have below. All right, so if I don't want to use the first one, I can use these other ones. So you are still going to get the same answer. Whichever one you use, you are going to get the same answer. All right, so I can also say beta assets or ungear beta is computed as beta equity of a gear company multiplied by 1 divided by 1 plus 1 minus tax rate of the proxy company, then multiply by debt equity proportion of the proxy. So this is another formula that you can use to calculate the asset beta, where debt beta is assumed to be risk-free. The second part, where debt beta is given, all right, where debt beta is given, let me copy this. Okay, number B, where debt beta is given. So how do you calculate asset beta? All right. So where debt beta is given is the same thing as the formula you have, the first formula you have there, except that you don't introduce the other parts. Okay. So this is the big for nothing formula you are supposed to use when you are calculating asset beta, where debt beta is given. Okay. So you use this combined formula. This other part is what you have where there's no debt beta. But where you are given debt beta, you need to introduce the other part, the second part of it. All right. So now note this. Okay, this information may help you as well. According to Miller and Modigliani, okay, I don't need that. Let me just go. You already have it in your notes. Don't let me waste time. Now, notes. The information, so that I don't want you to give what belongs to Peter to Paul, or you carry out, you use a figure that you're not supposed to use. So note the information about the proxy company, including equity value, debt value, debt beta, and tax rates. And tax rates should be used in steps 1 and 2 above. So what I'm trying to say here is that anytime you are calculating project specific cost of capital, for this step 1 and step 2, you need the information of the proxy company. Don't go and be using information of the main company. All right, you have to use the debt beta, the equity value, the debt value, the tax rates of the proxy company. All right, so that's why I'm trying to emphasize this. Then step 3. Step number 3 is to regear. Remember, from my acronyms, R is to regear. So I will then come here, regear. You regear to incorporate the financial risk of the main company. All right. So remember, in step 1 and step 2, your intention is to calculate asset beta, and you know that asset beta measures the risk associated with the industry. You want to calculate business risk. Business risk measures industry risk. So for you to be able to do that, you need asset beta. And to calculate asset beta, you use the formula I've given above. However, if the asset beta is geared, right? If there is debt in the capital structure of the proxy company, you cannot use the gear beta. You need to convert it to ungear. You need to unlever it. All right. You need to unlever it. You ungear it. All right. So now after you have unlevered you have ungeared the beta of the proxy company, you now want to calculate the WACC of the main company. So you already have your business, you already have your asset beta, which measures business risk. So the next thing you need to do is to then incorporate the financial risk of the main company by calculating the gear beta of the main company. Because cost of capital that you want to calculate, the WACC that you want to calculate must be consistent with the systematic business and financial risk associated with the project. And that is why you are regearing it. You want to include the element of financial risk. You want to include the element of debt into your cost of capital. Okay, so that's step number 3. Regear. All right, so how do you regear? The formula below, get out. I did not ask you that. The formula below can be used. Formula below can be used to regear depending on whether or not there is the beta. Okay. So let me just copy this. So where the beta is not given, or where the beta is risk-free, where that beta is risk-free, Then in this case, I don't need this one again. Let me see. Okay, copy this. Where the beta is risk-free, then the beta of a gear will be computed as beta assets multiplied by 1 plus 1 minus tax multiplied by debt equity proportion of the main company. Get out. Okay, so beta equity of a gear company is computed as beta asset that you have calculated in step 2, multiplied by 1 plus 1 minus tax rates multiplied by debt equity proportion of the main company. So this is the formula you are going to use to regear. All right, this is the formula you are going to use to regear. But where debt beta is given in the question, then you have to use the same formula you have in step 2, where debt beta is given. Let me copy this. All right, so where debt beta is given, so this is the same formula that you are going to use as you have it in step 2, except that in step 2, you are using information about the proxy company. But in this step 3, you are using the equity value, debt value, as well as the company tax rates of the main company. All right, you are using the tax rate of the main company. Okay, let me just put it down for you. Let me copy this. Note. Notes. The information of the main company. The information of the main company should be used. Main company, including debt value, equity balance, should be used in step 3 to 5. Step 3 to 5. Okay, step 3 to 5. So that's that. So like I said, anytime you want to regear, this is the formula you are going to use. If you are told that debt beta is risk-free, once you can see in a question that you are not given debt beta, then of course that's the formula to use. But if you are given debt beta, this is the formula to use to regear. However, you must use the information of the main company for step 3 up to step 5. Next, step 4 is to calculate cost of equity using capital asset pricing model. Okay, calculate cost of equity using capital asset pricing model. That's step 4. Let me just copy this. All right, that will save time. Yeah. So step 4. We calculate capital asset pricing model. So calculate cost of equity using capping formula as shown below. That's fine. No adjustments. All right. You're already familiar with this formula, so no need to talk too much on that. Then finally, step 5, calculate project-specific work. Step 5, we'll calculate project-specific work. Calculate project-specific cost of capital, that is work. Don't need this. You already know the formula for calculating work. That's step 5. So these are the procedures of calculating project-specific work. KW. All right. So like I mentioned, it is assumed that the company finances its its operation with only equity and debt, nothing like preference share under project specific. Don't waste my time. Okay. All right. So let me define the variables. Okay. To define the variables, I don't need all of this. I don't need you again. Thank you. Let me just. Hold on. I wanted to say, have I deleted? Let me just. All right. I don't need you too. So at this point, we can then have illustration, but let me complete this information here. So BA is asset beta, BEG is beta equity of a gear company. All right. Then E is equity value, D is debt value, T is company tax, then BD. Let me copy this. Let me put it here. BD is debt beta. Okay. This is debt beta. Then, of course, you already know KE is cost of equity, KD is cost of debt. You know risk-free rate of return. Let me just put it there for you. RF equal to risk-free rate of return, which is the rate of return associated with government security. RM equal to market return. Then the difference between market return and then risk-free rate of return is known as market risk premium. Because at times, examiner may not give to you the market return. You are going to be given risk-free rate of return. All right, so you have to know what to do. Then we have KD multiplied by 1 minus tax. That's after tax cost of debt. Okay. Let me put it here. Get that. Here is post-tax cost of debt. So that's that. So at this point, we can then have illustration. Let's have illustration. Okay. So these are the procedures that are going to carry out anytime you want to calculate project-specific cost of capital. Like I said, the first step is to identify the proxy beta. Step 2, you ungear the beta if it is geared. Step 3, you regear to incorporate financial risk of the main company. Then step 4, you calculate capital asset pricing model. All right. Then step 5, you calculate weighted average cost of capital. These are the 5 procedures you are expected to carry out anytime you want to compute project-specific cost of capital. You have to master the procedures. All right, you have no choice. So at this point, we can then have illustration. All right, so I need one of you to read for us. Yes, Amarachi, you are the one that offended me earlier, or the last person to offend me. Yeah, read for us, Amara. Amara, are you there? Amarachi. Oh, she has disappeared. All right, then. Yes, Matthew, go ahead. Thank you.
Kilimanjaro PLC produces domestic electric heaters. The company is considering diversifying into the production of freezers. Data on 4 listed companies in the freezer industry and for Kilimanjaro are shown below. We have Mississippi, Limpopo, Zambezi, and others. The par value per ordinary share is 25 kobo for Mississippi and Zambezi, 50 kobo for Nile, and 1 naira for Limpopo and Kilimanjaro. Corporate debt may be assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above the Treasury bill rate, which is currently 9% per year. Corporate taxes are payable at a rate of 35%. The market return is estimated to be 16% per year. Kilimanjaro does not expect its gearing to change significantly if the company diversifies into the production of freezers. You are required to 1. Estimate what discount rate Kilimanjaro should use in the appraisal of its proposed diversification into freezer production. 2. Corporate debt is often assumed to be risk-free. Explain whether this is a realistic assumption and calculate how important this assumption is likely to be to Kilimanjaro estimates of a discount rate in A above. For this purpose, assume that Kilimanjaro and the 4 freezer companies all have a debt beta of 0.3. 3. Discuss whether systematic risk is the only risk that Kilimanjaro shareholders should be concerned with.
All right, thank you very much, Matthew. Yes, that is the question. From the requirements, you have to calculate discount rates that Kilimanjaro should use in the appraisal of its proposed diversification into freezer production. Now, when you look at these requirements, examiner has mentioned diversification. So something should call your mind that this question relates to project specific, because here the examiner is asking you to estimate what discount rate Kilimanjaro should use for evaluation of its proposed diversification into freezer production. So from this requirement, it is clear that you are going to calculate project specific cost of capital. Not only that, when you go to the first paragraph of the question, examiner has mentioned to you that Kilimanjaro PLC produces domestic electric heaters. The company is considering diversifying into the production of freezers. So the company is moving from production of electric heaters to producing freezers. So this means that the company is diversifying. Therefore, what are you supposed to do? 5 steps, just 5 steps. The first step is to identify the proxy bidder. Who are the proxy? In this question, we are given 4 different proxy companies. We have Mississippi, Limpopo, Zambezi, and Nile. You then go to the information of the proxy company. Go and identify the bidder given to you. When you look at this table, the last line item in the table is the bidder equity, right? It is bidder equity of the proxy company and the main company. So you have 1.1, 1.25, 1.3, then 1.05 for the proxy company. You have, because you have 4 different proxy company, that's why you have 4 different bidders. So now what are you supposed to do? You need only 1 bidder. Therefore, you add up all the bidders. You then divide it by 4 because you have 4 proxy company. If you have only 2 proxy company, you add their bidder, the 2 together, you divide it by 2. If you have 3 proxy companies, you had the three betas together, you divide it by 3 just to get the average beta. All right, because that is the beta, then you are going to ungear if it is geared. So without wasting more time on this, let's quickly solve the question. So we want to calculate project-specific cost of capital. So I would then say solution. The name of this company is Kilimanjaro PLC. So we want to calculate, we have identified from the question that this company is diversifying. Yes, Matthew, talk to me.
This question, is it in the material or I don't know, sir.
It's in the learning material.
Okay,
All right. Go to, I think, illustration number 20 under cost of capital. You say that. All right. So, like I said, if you want, you can just say calculating project specific cost of capital. And you know that to do this, like I mentioned, if you are the one solving this question on the day of your exam, just write it out. If you don't want to make mistake, you can just write it out. PURCW. You then begin to pick it one by one. All right. So the first step is to identify the proxy beta. There's no need for you to say identify the proxy beta. Simply say proxy beta. All right. Let me copy all those steps that we have before to make life easier. Anyone I don't need, I will remove it. No story. I don't need all this explanation. Okay. So, like I said, the first step that we need to do is to identify proxy beta. So there's no need for us to say identify proxy beta. Simply say proxy beta. That is, if you are the one solving this question on the day of your exam, don't say identify proxy beta, just say proxy beta. We then go to the question, what are the proxy betas? In this question, we have 4 different proxy companies, okay? We have 4 different proxy companies. I don't need to label it. Okay, should I? Leave it. So you have 4 different proxy companies in the question. So you can then say beta. Let me copy. Do I have beta here? Yes. Let me just copy this. Okay. So we need beta according to the question. Since we have 4 different proxy company, we need beta of Mississippi plus beta of Limpopo plus beta of Zambezi plus beta of 9. Then divide it by 4. Let me copy this one also. All right, so that's all you need to do. It's as simple as that. Remove E. Then you divide it by 4. If you have only one proxy company in the question, no need for you to be doing all of this. Just pick the beta as given to you, that's all. All right, but in this particular question, because we have 4 different proxy company, that's why we're adding the betas together and divided by 4. Okay, so don't go and be thinking that at all time it will be 4 company or 4 proxy company. It doesn't work like that. So what's the beta of Mississippi? 1.10. Limpopo is 1.25. Is it 1.25? Let me confirm.
Yes, 1.25.
Yes, 1.25. Then Zambezi is 1.3. Nile is 1.05. So add everything together and divide it by 4. What do you have there? Give it to me. Final answer.
1.175.
1.175. Thank you. So as you can see, the beta given to you in the question are in 2 decimal points. Your final answer also must be in 2 decimal points. So 1.175 rounded to 2 decimal point is 1.18. So with this, we have identified the proxy beta. Then step 2 says we should ungear the beta if it is geared. I will then go to the question to go and check if this beta in step 1 is geared. So, and I said the beta will be geared if the proxy company has debt in its capital structure. When you look at the question, you are given bank loan for the proxy companies. So it means that this beta is geared. This beta of 1.8 is geared. Okay? So if the beta is geared, then you need to ungear. Now, to ungear, I gave you 2 different formulas that you can use, depending on whether or not debt beta is given, right? So in the question, we are not given debt beta, all right? We are not given debt beta in the question. So it is assumed that debt beta is risk-free, all right? So if debt beta is risk-free, then we are going to use the first formula as given to you. Somebody will ask me, Chibi, we have debt beta in this requirement number 2. Yes, this debt beta of 0.3 is meant for requirement number 2. So it's not given in the question. So examiner purposely give you this debt beta of 0.3 in requirement number 2 for the purpose of answering requirement number 2. All right. So all through the question, apart from that requirement number 2, we are not given debt beta. Therefore, it is assumed to be risk-free. So if debt beta is risk-free, so I can either use this formula, okay? I can either use this formula. Let me put it down for you. Since debt beta is not given in the question, since debt beta is not given in the question, it is assumed to be risk-free. Therefore, the formula below will be used to ungear or to calculate asset beta. All right. Okay, so I don't need this. If I like, I can use this formula. If I like, I can use the second one. Whichever one I use, I will still get the same answer. Chairman Felix, I've marked your face. No worry. You are going to pay for that noise that you are making in my class. You pay for it. All right. So let's just use any one of them. So anyone we use, we are good. Let me remove this. So let's use the first one. Therefore, I will then go to the question. The beta we have identified in step 1 is 1.18. All right. So this is 1.18. Then I need equity value as well as a debt value and tax rates of the proxy company. So I need to go and calculate it. Oh, sorry, I made a mistake. I wanted to, yeah. So I need to go and calculate equity value of the proxy company. So let me do my working. Working number 1. I want to calculate market value. I need equity and debt value. So market value. How do you calculate market value? The same way you normally calculate market value under traditional work. It's the same way we are going to do under project specific. Nothing has changed, except that we don't have anything to do with whether dividend has been paid or not. We are less concerned with that because we don't use dividend when you are calculating project specific work. All right. So I want to calculate equity value. Equity value denoted as E. Equity value denoted as E. Before I put down my formula, I need to go back to the question to identify whether I'm given number of ordinary shares or I'm given share capital. In the question, we are not given number of ordinary shares. We are given share capital for each of the companies. All right. Therefore, our market value of equity will be computed as share capital. Okay. It will be computed as share capital divided by nominal price. Okay, this should be computed as share capital divided by nominal price. In the question, the examiner did not call it nominal price. It is called par value. So you can call it par value or face value, whichever one is the same thing. Then multiply by share price. You know, under traditional work, we call it ex-dividend share price. So, but here, we were less concerned whether dividend has been paid or not. Just bring out the share price. Therefore, we are going to do for the proxy company. We calculate for the proxy company. There are 4 different proxy companies. We have Mississippi. Okay. Therefore, what is equity value of Mississippi? So give it to me. We want to calculate equity value of the proxy company. So we are starting with Mississippi. What's the share capital of Mississippi in the question? Matthew, be my partner. Yes?
Yes, sir.
Equity
4,000.
value of 4,000. Then what's the par value of Mississippi? You have to be very careful in this question so that because examiner has put students in on the express, they combine the par value of 2 different
25,000.
companies together. If care is not taken, the student can give what belongs to Peter to Paul. So you have to shine your eye. So we are told that the par value per ordinary share is 25 kobo for Mississippi and Zambezi. So par value of Mississippi is 25 kobo. So if that is the case, this one will be 0.25. 25 kobo is 25 divided by 100. That's 0.25. That's the par value. We then need to multiply this with share price. I will then go to the question, how much is the share price given to me for Mississippi? So when you look at the information given to you in the question, we are not given share price, okay? We are not given share price, but we have information to calculate share price. Let me show you what you are supposed to do. You will note, you will record that for, I don't know if you have done financial statement analysis. If I'm not sure, Mr. Shuaju has not taken you, then you're also going to do that in financial reporting. All right. However, in the financial statement analysis, specifically for ratio analysis, that's what we call investors ratio, or you can also call it market ratio or shareholders ratio. Under the shareholders ratio, one of the ratios is what we call price earning ratio. Okay, so share price. Let me put it this way. Let me come here. All right. So we said price earning ratio is computed as share price divided by earnings per share. This is the formula for calculating price earning ratio, right? Under ratio analysis, investors ratio. All right. So you can see we are looking for share price. Share price is not given in this question, but examiner has given us price earning ratio. You are also given earnings per share. Therefore, what are you supposed to do? The most important thing to do is to just cross multiply. That's all. Therefore, share price will be equal to, according to this question, will be equal to price earning ratio multiplied by earnings per share. That is how you are going to calculate your share price. That is what examiner has hidden in the question. That's what examiner has hidden in the question. Okay, so let's then continue. I will then come here. According to the question, what's the price earning ratio of Mississippi? Price earning ratio of Mississippi is 12 times 12. Then
12.
earnings per share of Mississippi is 25 kobo. Therefore, 12 multiplied by 0.25. 12 multiplied by 0.25. When you do this, what do you have there? This will give us 4 naira, 3 naira. All right, so that will give us 3 naira. Then what do you have? 3 multiplied by 16,000. That should give us 48,000. All right. Next one, Limpopo. Let's copy this. For Limpopo, I will then go back to the question. What is the share capital of Limpopo? According to the question, Limpopo has 9,000 share capital. Then what is the par value of Limpopo? 50 kobo for 9 and 1 naira for Limpopo. So 1 naira is the par value. So 9,000 divided by 1 naira. Okay, divided by 1 naira. Then I need the price earning ratio of Limpopo. Price earning ratio of Limpopo is 10 times.
Right.
Earnings per share is 0.533. Okay. Here is 10. Here is 0.533. When you multiply that with 10, that will give us 5.33. So 5.33 multiplied by 9,000. What do you have? Give it to me.
47,970.
47,970. 47,970. That's it. The next one is Zambezi. All right. What is the share capital of Zambezi? Zambezi has 3,500. The price earning ratio is 9. The earnings per share is 0.381. Okay, so here is 3.5. Share capital 3.5. Then, of course, price earning ratio is 9. Earnings per share is 0.3. Is it 381? Let me confirm. Yes, 0.381. Then the price earning ratio, sorry, the par value of Limpopo, is it Limpopo? Zambezi, yeah, is 25 kobo. All right, the par value of Zambezi is 25 kobo. So 3,500 divided by 0.25. Okay, that will give us 14,000. Then 9 multiplied by 0.381. What do you have? Yes.
3.429.
3.429. Okay. So 3.429 multiplied by 14,000. What do you have?
48.
48,006 naira.
48,006. That's it. Next one. The last one is 9. Okay. What's the share capital of 9? According to the question, 5,300. What is the par value of 9? The par value of 9 is 50 kobo, 0.5. 5,300 divided by 0.5. 5,003 divided by 0.5. Then price earning ratio of 9 is 14. Earnings per share is 0.323. Okay, 14 multiplied by 0.323. 14 multiplied by 0.323. Okay, so what do we have here? 14 multiplied
4.522.
4.522 multiplied by 10,600.
47,933.2.
933. So that's that. We have calculated the market value of equity of the proxy company. So let's determine the total market value of equity of the proxy. Total market value, total equity value, total equity value. We then add up everything. $48,000 plus 47.
191,909.
191,909.
909.
Thank you. So that's the total. That's the total equity value of the proxy. Let me push it to the front. Okay. Let me bold it. All right. So that's the total equity value of the proxy companies. So you then determine the debt value. Let's determine the debt value. When you look at the question, the debt value, the debts given in the question for the proxy company are bank loan. So, bank loan is a form of non-traded debts. That is, it is not tradable. You cannot have market value for bank loan. Therefore, it is the book value that you are going to use. So, debt value, let me remove board. Debt value denoted as D is equal to the bank loan, which is not tradable. All right. Therefore, debt value will be equal to market debt value of bank loan of Mississippi plus bank loan of Limpopo plus the bank loan of Zambezi and then plus bank loan of Nile. So that will give us the total debt value. So give it to me in the question. What's the debt value? What's the bank loan of Mississippi?
53.
5,300.
5,300 plus that of Limpopo.
12,600.
12,600 plus Zambezi.
18,200.
18,200 plus 9.
4,000.
4,000.
So when you add up everything, what do you have there?
40,100.
Okay, 40,100. So we have debt value to be 40,100. We also have equity value to be 181,909. So we can go back to our calculation. You can see we have abandoned this for the past few minutes because the figures we are looking for is not in the question. So we need to go and calculate it. At times, examiner may not give it to you in terms of value, the way we have done. If examiner want to help you, they are going to give to you debt equity proportion. All right, they can just tell you that equity is 40%. So if debt is 40%. So if debt is 40%, equity will be 60%. All right. So at times they can give the gearing ratio to be 20%. It means that debt is 20, equity is 80%. All right. But if examiner defines your gearing ratio for you in the question, then you have to use what examiner has asked you to use. All right. So at times, examiner can tell you, they can define the gearing ratio to say that for this purpose, the gearing ratio is assumed to be, or your examiner can tell you, assume a gearing ratio of debt over debt plus equity. That means examiner wants you to use total value. All right. You have done capital structure. So Mr. Ashwaju has taught you gearing ratio. So debt you can use single value to calculate your gearing to say debt over equity. That's one way. You can use total value by saying debt over equity plus debt as your denominator. So whichever one. But if examiner does not define your gearing ratio for you, you are at liberty to use anyone. But anyone you use at the end of the day, you just have to state your assumption. Okay. So here is 191,909 divided by 191,909 plus the debt value is 4,100. I will then go back to the question. What is the tax rate of the proxy company? In the question, you are given only one tax rate, which is 35%. So corporation taxes are payable at the rate of 30%. Pay attention, please. I mentioned to you when I was giving you the steps. In step 2, like I said, you are supposed to use information about the proxy company for step 1 and step 2. For step 3 up to step 5, you need the information of the main company. At times, examiner may give you different tax rates for both for the proxy as well as the main company. At times, examiner will give you debt beta for the proxy company, then you'll give you another debt beta for the main company. At times, they will not give you any debt beta. At times, examiner will give you debt beta of the proxy. You are not going to be given debt beta for the main company. So you just have to shine your eye. Whatever information you are using must relate to either proxy company or the one relate to the main company. Don't go and mix them together if examiner does not ask you to use it. Like in this case now, the corporation tax, we are given corporation tax at the rate of 35%. We are not told whether this one is meant for proxy company or Kilimanjaro. Therefore, you are going to assume the two companies will pay the same tax rates. So that's that, because we don't have other information. So I will then come here. So 1 minus 30% will give us minus 35% will give us 0.65. All right. So give it to me. What's your final answer here? So you are going to start from the denominator.
0.88.
0.65 multiplied by 4,100 equal plus 191,909 equal. You then pick the numerator, 191,909 divided by answer equal, multiplied by 1.18. What do you get? Final answer? Final answer?
1.04.
Yes. 1.04. Thank you. You are correct. Yes, Emeka, talk to me quickly.
Good evening, sir. Please, how did you
good
get
evening.
that 0.6?
How did I get what?
That's 0. I thought it was 0.35 they gave us.
Hey, now 1 minus tax. Your tax rate is 35%. 1 minus 35% is 0.65.
Okay, sir. Thank you.
You're welcome. So the next thing we need to do now, we have ungeared in step 2 using the information of the proxy company. The next thing we need to do is to then regear. So again, debt beta is not given. Therefore, to regear, we use, let me copy from here. All right. So this is the formula to regear. Let me put some comments. Debt beta, the debt beta of Kilimanjaro is not given. It's not given. Therefore, the formula below, don't go and be writing things like this on the day of the exam. It's a waste of, if you write it, no worry, no penalize, examiner will not penalize you, but it's a waste of time. Therefore, the formula below will be used to regear. Okay, that's step number 3. We want to regear. So beta equity of a gear company equal to beta assets multiplied by 1 plus 1 minus tax multiplied by debt equity proportion of Kilimanjaro. So we have calculated asset beta to be equal to, the asset beta we calculated is 1.04. 1.04, that's the beta you have. You cannot jump any step. You have to follow it in that order, step 1 to 5. You can't jump step 2 and move to step 3 or step 4. So you have to follow it in that order. All right. So multiply by 1 plus the debt equity proportion, 1 minus tax rates. 35% is the tax rate. 1 minus 35% will give us 0.65. Then I need the debt equity proportion of Kilimanjaro. We need to go and calculate it the same way we calculated for the proxy company. Okay. So let me just copy this last one here. So for the proxy, here is for the Kilimanjaro. All right. So, okay. So equity value of Kilimanjaro, according to the question, what's the share capital of Kilimanjaro? 4,000. What's the par value of Kilimanjaro? 1 naira. So 4,000 divided by 1 naira. $4,000 divided by 1 naira. Then, what's the price earning ratio of Kilimanjaro? 8. Then 106 is earnings per share. 8 multiplied by 1.06. 1.06, then multiply by 8. What do you have there? That's 8 point what?
8.48.
So multiply by 4,000.
That's 920.
920. All right. So that is the market value of equity of Kilimanjaro PLC. The next one is the debt value. So, like I said, Kilimanjaro also have bank loan. How much is the bank loan of Kilimanjaro?
17,400.
17,400. It's not tradable. So that's that. I can then say, because I'm calculating work for Kilimanjaro, I would need the total value. I would need the total value of equity plus value of debts. All right. So this would be equal to, let me push it down. So that when I'm calculating my work, I don't need to be doing it one by one, since I already have the total. So the total value would then be value of equity, which is 33,920, plus value of the debts, 17,400. When you add the two together, that will give us 51,000 what? 320. All right, so that's total value. So I can then come back here. So the debt value of Kilimanjaro is 17,400 divided by equity value of Kilimanjaro, which is 33,920. So from your calculator, you are going to start from 17,400 divided by 33,920 equal, multiply by 0.65 equal to, then plus 1 equal, multiply by 1.04. Give it to me. What do you have there? Yes. What do you have? Okay, let me use my calculator. Like you are not ready.
1.387.
1.39.
1.39. That's it. Thank you. So step 4 now says we should calculate capital as a pricing model. I will just come here, copy him. That's step 4. Let me copy. I think I have I don't need all of this again. I will still need this one later. Yeah, this is it. Yeah. So I want to calculate capital as a pricing model, denoted as KE, cost of equity. That is step number 4. So cost of equity is computed as risk-free rate of return plus beta equity multiplied by market risk premium. So according to the question, what is the risk-free rate of return? Pay attention. Examiner told us that corporate debt, in the last paragraph, corporate debt may be assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above the threshold bill rate, which is currently 9% per year. So threshold bill rates, like I mentioned to you in our previous class, risk-free rate of return is the rate of return associated with government securities. Okay, like treasury bill, like government, federal government bond. All right. So any rate of return that is associated with government security is risk-free. Your investor's money is secured. Investor cannot lose money when you invest in government security. That's why it is risk-free. So risk-free rate of return is 9%. However, your corporate debt, we are told, is available to the company at 0.5% above the threshold bill rates. So what this simply means is that your cost of debt, your KD, your interest rates is available at 0.5% above 9%. So this simply means that interest rates is 0.5 plus 9%, which is 9.5%. So I will then come here. So here is 9 multiplied by the BD, sorry, the beta equity of a gear, 1.39. Okay, 1.39. Then market return, according to the question, market return is what? 16%. The market return is estimated to be 16% per year. Okay.
16% per year.
Yeah. So here will be 16 minus the risk-free rate of return of 9 minus 9. Therefore, what do you have as your final answer?
So I thought you said it is 9.5.
Your risk-free rate of return is 9%. Cost of debt is 9.5.
Okay.
So what's the final answer?
18.73.
18.73%.
Yes.
All right then. So that's the cost of equity. Then finally, you calculate WACC. You calculate project specific cost of capital. Write
Sir,
it out.
what is sir? Hello, sir. Yes, how do you get that RF to be 9?
I've told you, if you want to ask me, always raise your hand.
I'm sorry, sir.
Hmm?
So sorry.
So how did I get what?
The RF to
That's the
be,
risk-free rate.
yes, the risk-free rate.
How did I get it?
Yes.
Is it a question? I should be adjustment. I mentioned it that examiner has told you is available at 9%. Threshold rate, which is currently 9%, is there in the questionnaire?
Thank you.
You are welcome. Somebody was raising hand the other time. Emeka, what's your question?
That's the same question I wanted.
Okay. So finally, we calculate WACC. So let me just copy the formula I have here. Wow. So does that mean we are not going to finish cost of capital today? I have to change my approach going forward. All this thing I'm writing down, I have to stop it. It's wasting time. All right. So to calculate WACC, you multiply cost of equity. Let me change this one to the other side. Okay. So to calculate WACC, you already know the formula. So equity value of Kilimanjaro, we have calculated 33,920. The total value of equity and debts, according to the question, and based on our calculation, we got 51,320. All right. So cost of equity, we calculated 18.73%. Okay. Yes. 18.73%. Then the debt value also, we have 17,400. Total value of equity and debts, 51,320. So cost of debt is not given in the question, but examiner has told us that the cost of debt is 0.5% above 9%. So 0.5 plus 9 will give us 9.5%. 1 minus tax rates. Tax rate is 35%. 1 minus 35% will give us 0.65. So give me from the left. What do you have there? 33920 divided by 51320 multiplied by 18.73. What do you have? Yes. Matthew, are you still there?
2.09.
From the right or from the left?
12.38 from the left.
12.38. Okay. That means from the right is 2.09. So when you add the two together, our work will then become 14.47%. That's it. Note, our KD, we are told that corporate debt is available at 0.5% above threshold bid, that is 0.5 plus 9%. So that's how we got the 9.5%
Cost of debt.
cost of debt. Yeah. Yes, Biola, talk to me.
Good evening, sir. So
Yeah.
I want to ask this project specific. Can we have preference shares in it? Can it be? Would there be preference shares introduced to it?
I've said it before now.
Apart from
I said it is assumed that the company is financed with only equity and debt, no preference share. When you are calculating project specific, there's no preference share. All right?
I thought it's also a debt. Okay, thank you, sir.
You're welcome. So this answers requirement number A. Requirement number 1. Let's quickly go through requirement number 2. So for the requirement number 2, we are told that corporate debt is often assumed to be risk-free. Explain whether this is a realistic assumption and calculate how important this assumption is likely to be to Kilimanjaro's estimates of a discount rate in A above. For this purpose, assume that Kilimanjaro and the 4 freezer company all have a debt beta of 0.3. So in this particular requirement number 2, examiner wants you to do 2 things. The first one is for you to explain if truly corporate debt is risk-free. When you are done doing that, you then need to calculate, you need to recalculate your project-specific work where you are given a debt beta of 0.3. All right. So what will be the impact on your work if you are given a debt beta? So that's what you are supposed to do in this requirement number 2. Let's quickly explain that. Yes, Ruth, what's your question? Quickly.
Okay, sir. In a situation whereby, okay, like this, we have 4 product companies, whereby, let's say 2 or 3 of the companies has debt beta and 1 or 2 don't have. How do we
That's
ungate
not
that?
possible. You can't
It's
have
not
that
possible.
you can't have that kind of scenario. Yes. You
Okay.
see that all of
They will
them
all
have.
be geared, or they will all have gear beta, or they don't have gear beta.
You can't have a mix. So it's either they have a they have a gear beta or not or on gear. So you can't, one cannot be on gear and the other one is geared. So that would be very
Okay.
cumbersome. Yeah. So yes, number 2 requirements. Requirement number 2A. Requirement number 2A. Corporate, let me do it this way. Requirement number 2, okay, 2A. Corporate debts. So examiner is asking you to explain that corporate debt often assumed to be risk-free. Explain whether this is a realistic assumption. So what the examiner is trying to tell you here is that, is it true that corporate debt is risk-free? That is that if you borrow a company loan, you cannot lose your money. You are going to get your money back. Is it true? All right. So if you think it is true that corporate debt is risk-free, you justify your points. If you think that it is not true, you also justify your points. All right. So that's what the examiner wants you to do. So in our own case, we are going to negate the assumption. So I will then come here. The assumption that corporate debts, because of time, I wish if I thought I can't do calculation under Wakoka. I should be able to explain Wakoka. Let's see. The assumption that corporate debts is risk-free is not realistic because of the following. Okay, because of the following. Number one, liquidation. Now, when a company liquidates, the assets of the business will be disposed of, and the proceeds therefrom will be used to settle the liabilities. All right. So, if at the end of the day, the amounts realized from the disposal of the assets cannot cover the liabilities, so what will happen to the balance of the debt? That means to be forfeited. On that note, we cannot say corporate debt is risk-free, all right? Because once a company liquidates, there's nothing you can do. You can't use the company's, the shareholders' private asset to cover the debt. That's not possible because every business you run as a limited liability company, which means that the liabilities of the owners of the business is limited to the capital contributed, all right? So you cannot use the private property or private assets of the shareholders to offset the liability. All right. So that on that note, you cannot say corporate debt is risk-free. So liquidation. When a company liquidates, when a company liquidates, its assets will be disposed of, and the liabilities will be settled therefrom. Any liability or debts, any liability not covered by the proceed from the assets, from the asset disposal, will be forfeited. Okay. So on this note, we cannot say corporate debts. So you can imagine, let's say, for example, a company is owing 1 million naira to creditors, and then because the company is facing financial challenges, so you cannot continue on a going concern basis, we then liquidate the company, we sell all the assets of the company, we realize 800,000. Meanwhile, the company is owing debt of 1 million naira. So you sold all the assets, you realized 800. What will happen to the balance of 200,000 naira? That will be forfeited. So on that note, we cannot say corporate debt is risk-free. That means the creditors, they have lost 200,000 naira. That's the implication. Number two, default risk. Yes, Matthew, what's your question?
I'm not seeing your screen, sir. The screen is blank. I don't know whether it's only from my end.
I'm sure it's
Please,
from
can you
your
confirm?
end.
Your end, though.
I'm sure it's from your end,
I
not
can
the
see you,
network.
sir. It's from your end. We can see you. Sir.
All right. So the second one is default risk. So you can check, Matthew, you can You can close your screen and then put it on again. All
Okay,
right.
sir.
So default risk. The default risk is the inability of a company to pay both the interest and the principal at the maturity dates. All right. Let's say, for example, a company is owing you, right? A company is owing another company loan, or a company has advanced loans to another company, and then this loan will mature in 5 years' time. In the first year, the company pay interest. The second year, the company pay interest. The third year, the company pay interest. Fourth year, the company is unable to pay. The final year, which is the redemption date, the company is also yet to pay. They've not paid the interest of the fifth year and of the fourth year, as well as the principal amount. So when the company defaults, all right, when there's a default, what can you do? The worst case is for you to go to court, all right? So you cannot force the company. So the worst case will be that, okay, you can't sell the company's assets. That is not right. The court to a job, we settle the matter. But the bottom line is that anywhere where your debtors default, there's possibility that the company will not be able to recover the entire amount. Just like, for example, you have a tenant in your house, right? And then this tenant has been owing for like 6 months, all right? The, the rent was due and then could not pay up to like 6 months. Then you now ask the tenant to vacate your property, right? So how do you recover the outstanding rents of 6 months? All right, the tenant has default. So what do you want to do? So this is what we are saying. So where there's a default risk, or where there's a default, it's not possible it will not be possible, or it will be difficult, all right, for the company to recover the entire amount. All right. So on that note, we cannot say corporate debt is risk-free. Okay. So I said default rate. This is the risk arising from the inability of a company to pay interest and the principal at the maturity date. Under this circumstance, it is, let me put it, under this circumstance, it is almost impossible to recover the entire amount or the entire debt. To recover the entire debt, debt amount. Therefore, because of time, that's okay. Let me just come here. From the foregoing, from the explanation above, it is clear that corporate debt cannot be said to be risk-free. It is only in theory or on paper. It is only in theory or on paper, not in practice. Okay, it is not in practice. Corporate debt is never risk-free. It is only government security that is risk-free. So these other parts of these requirements, we are given debt beta of where debt beta of 0.3 is given. So we are given debt beta of 0.3. Therefore, we need to recalculate our WACC and see the impact of a debt beta on the WACC. So let me just copy the one we have done before, so that it will be faster. Let me copy all of this. So after today's class, you need to go ahead, go and solve the question in November 2025. If you can solve this one, you can solve any question under project specific. This one is more difficult than the one given in November diets. Okay. Oh, where am I? Okay. So because we are given debt beta of 0.3, so we need to recalculate. Our proxy beta will remain the same as 1.18. I don't need all of this. All right. Proxy beta remain 1.18. All right. Then we need to ungear. I don't need all this information. So to now regear, okay. So to regear, I need to, let me go and copy that. To regear, because we are given debt beta of 0.3, so you are going to use this big for nothing formula. All right. So that's what we are going to use. It is well. So I will then, let me remove this. Okay. That means since debt beta of 0.3, since debt beta of 0.3 is given, all right. The formula below, will be used to ungear. So that's that. So to ungear, we have calculated the other parts. It's the same thing. The only one we need to put in there is the second part here. All right. So plus. So we have been given debt beta of 0.3. Here is 0.3. Then debt value is 4,100. 1 minus tax, 1 minus 0.35, we give us 0.65. Then, of course, let me just copy this. Get out. Okay. So, we have gotten the answer of the left side. Give me the answer of this other side where you introduce the beta, debt beta. What do you have? So we have calculated this one before to be equal to 1.04. Yes, plus, what do you have there? 0.65 multiplied by 4,100 plus 1919009 equal, then 40,100 multiplied by 0.65 divided by answer, or multiplied by 0.3. What do you have? 0. What? Am I on my own? Okay, let me use the calculator myself.
Oh, sorry, sir. I was speaking. I was muted. 0.04.
0.04. Thank you. So when you add the two together, that will give us 1.08. So asset beta, where we are given debt beta of 0.3, is calculated as 1.08. We then re-gear to incorporate the financial risk. Again, debt beta is given as 0.8. Debt beta is given as 0.3 rather. Therefore, to re-gear, you just repeat the same formula you have here. You repeat the same formula you have here. I don't need this. All right. So in this case, we are using the information of the main company, not of the proxy company. So here will be 1.08. All right. Then the equity value of Kilimanjaro is 33,920 over 33,920. Debt value is 17,400. Then, of course, here is, somebody should give me from the left. Here is 17,400. Okay, 17,400. Then here is 33,920. What do you have from the left?
0.75.
0.75. Thank you.
Is our
Sorry,
confirm.
what am I saying? Sorry, the beta assets. The beta asset, look up, the beta asset we want to calculate is given as 1.08. We are looking for beta equity. Beta equity is what you want to calculate, which is the BEG, because you want to re-gear, right? So the beta asset, you've already calculated it in step 2. So that's 1.08. Therefore, equal to BEG. Let me copy this. We are looking for BEG. We don't know the BEG, that's unknown. Therefore, here will be 1.08 equal to BEG. You say 0.75, right? 0.75
Yes,
BEG. Then from the right, what do you have from the right-hand side? What do you have here?
promising. Okay.
That's 0. What?
0.075 from the right.
0.75. All right, then. So you then collect like terms. You collect like terms. All right. So here will then be equal to 0.75 BEG. Will be equal to 1.08 minus 0.075. So final answer will then be equal to BEG. All right. This will be BEG equal to 1.08 minus 0.75. That will give us 1.005, Abi.
Yes, sir.
Then,
Yes.
okay. Therefore, BEG divided by, let me copy, this one is smaller. Therefore, beta equity of a gear will then be equal to, let me copy this side. So beta equity of a gear will then be equal to 1005, sorry, 1.005 divided by 0.75. So what do we have there?
1.34.
That will give us what?
1.34.
1.34.
Okay. Equal to 1.34. We then calculate, that's a gear beta. We have re-gear now. So we then go ahead and calculate our capping. Already know the formula, no need to rewrite it again. So here will be 1.34. The difference between 6 and 9. So what's your final answer? 18 point what? What's your cost of equity?
18.38.
18.38%. Finally, you then calculate WACC. You have written the formula before, no need to rewrite it again. All right. So the only thing that will change here is 18.38. Every other thing should remain the same. All right. So 33,920 divided by 51,320 multiplied by 18.38. What do you have?
12.15.
12.15%. WACC we computed where debt beta is introduced. Where debt beta is introduced, our WACC is 14.29. Where there is no beta, our WACC was 14.47. So there is a margin of error. There's a margin of error between, when debt beta is introduced, our cost of capital is reduced by marginally by whatever the percentage. You can compare. If you want to do further analysis, you can say 14.47 minus 14.24 divided by 14.47. So that will give you the percentage reduction when debt beta is introduced. Okay, so that's basically that. Of course, finally, in the question, examiner wants you to calculate, to discuss whether systematic risk is the only risk that the company shareholder should be concerned with. So, of course, for you to be able to answer that, you need to explain what is systematic risk, what is unsystematic risk. So when we get to portfolio theory, I will explain to you in details what project risk is, portfolio risk is all about. However, when you talk about systematic risk, it is a kind of risk that affects every company in the economy. Like we experienced in 2020, COVID-19. COVID-19 affected everybody in the entire world. So in the whole world. So in that's the kind of risk we are talking about. So, and it is non-diversifiable. Whereas unsystematic risk is the risk that is peculiar to a particular company or industry. All right. Any risk that's related to a particular company, it is unsystematic risk. Like we recently, like the banking industry, the regulatory change in the banking industry in recent time, whereby the CBN roll out the capitalization exercise for banks. All right. So that's recapitalization exercise relates to only banking. It doesn't affect other sectors like manufacturing, like real estate, whatever, like agri. It doesn't affect all of that. It is basically for the banking industry. What that simply means is that any bank that could not meet up with the recapitalization, that could not meet up with the recapitalization exercise, its license will be withdrawn, or the company may be absorbed by a bigger bank, or the bank can decide to merge with a comparable company in the industry. So that is unsystematic. So for you to be able to explain this properly, you need to understand what is systematic risk, what is unsystematic risk. You then make your final position saying that the company shareholder should be concerned with the total risk that affect the business, both the systematic and non-systematic. All right. So because as a shareholder, you cannot be selective. All right. You have to consider the entire risk, the potential risk that will impact the operation of the business. So that's that. I will not be able to take it on Wakuka today. So let's have an alignment, okay? Because when next we are meeting by the grace of God, we are going to be having the capital budgeting. Therefore, between now and Sunday, so I may likely have you either on Saturday evening or on Sunday evening, depending on. I will let you know. I will let you know. All right, so that we can finish the outstanding scope within 1 hour. We are done with the Wakuka, so that we have to accelerate. Going forward, I have to change my approach. It's like all this writing I'm doing is wasting time. All right, so that's that. Let me know if you have any question for me so that I can release you.
Yes, sir.
Talk to me. Any question for
Okay,
me?
in the previous one where we use the formal information, where we needed to compute for debt equity portion of Kilimanjaro, I found out that you divided the bank loan, the value of the bank loan by 1. Is it because the par value of shares for that company was 1 naira?
I divided bank loan by 1. How?
Yes. I think it was 4. I don't know if I can see the question.
In this same question of Kilimanjaro.
Yes, sir. The first
Okay.
the first one you saw, the debt equity proportion of Kilimanjaro.
Is it in the working or in the main calculation?
I think in the working.
I'm not sure I divided anything by 1 or
in the working.
This is the work.
Okay,
this is the working
bank.
now.
This is the working. Sorry, the equity. Yeah, sorry. The equity.
And now the par value of Kilimanjaro is 1 naira now.
Okay, fine. I get it. I was mistaking it. I thought that was the value for bank loan. So I was wondering why it was divided by 1. I've seen it now. Is that? Thank you, sir.
Okay. You're welcome. So any question so that I can release you?
Sir, will you be sending these workings to us? Will you be sending these workings to us?
Certainly.
So we can go through again.
Certainly.
Thank you, sir.
You're welcome. Okay. So in the absence of no further question, I want to say thank you for waiting behind. I will see you next time by the grace of God, when we shall continue. Like I mentioned, between now and the latest Sunday, we are going to have a makeup class for us to be able to complete this, so that on Monday, when we are meeting by the grace of God, we are going to be starting a new topic. All right. Okay, then. Good night, everyone. Bye-bye.
Good night,
Thank you, sir.
Thank you, sir. Good night.
Thank you very much, sir. Good night.
Good night.